Hi viewers, this is Paul Minor Jidlaf of SmartMark Financial Consults, the media that intentionally informs and imparts financial skills for people to be able to be empowered financially. Welcome. Our focus today is on personal finance, and in this video I want to share about tax avoidance strategies and how it works towards wealth creation. Remember, creating wealth is not a mystery but a formula, and unless you understand on how to apply the formula, their importance remains hidden. Our desire is to open your eyes to these facts, for the Bible says, "My people perish because of lack of knowledge." In this video, we reveal to you secrets which will help you get empowered financially at whatever level you are at. Our topic today is tax avoidance towards wealth creation. The secret to making money by legally not paying taxes is called tax avoidance. If you are given an opportunity to choose on either to pay or not pay taxes, majority of us will choose not to pay. But do you know each one of us has the opportunity on deciding how much to pay on taxes or not? Some pay less, others pay more, depending not only on the level of their financial knowledge at their disposal, but also on their willingness to apply that knowledge. If you want to pay less tax, then you need to reduce your taxable income by understanding the tax loopholes so that you can keep more of what you earn legally. Money management is not only about reducing your expenses, but also to maximize in keeping or safeguarding what you have earned. There is need, therefore, to know and understand what incomes are taxable and how to intelligently negotiate and make part of your income to become non-taxable. For the more taxable income you have, the more taxes you will pay, and the less taxable income you have, the less tax you will pay. Tax avoidance is therefore a strategy on how to pay less taxes legally. It's important to not only know ways to keep the money you earn so hard, but to also understand how to reduce the amount of money you spend on taxes by decreasing your taxable income. Therefore, using the tax loopholes at your disposal is making the tax system work for you and not against you. For your information, the tax laws are set in a way that they are always in favor of the investors and business owners. For unlike a former employee who pays taxes before expenses, the investors and business owners pay their taxes after all their expenses. Well, we go to school to learn how to work hard for money, but we should also get financial education to learn on how to retain the earned money and make it work harder for us. We need to know whether to study money character, have money skills, and partner with it to generate more. Yes, I said partner with money. Someone said money is your personal army, and it should go out and bring back prisoners. Few people know very little about how money works, no matter the level of education or profession, because school wasn't designed to give education about money, how to make money, how to save money in taxes. As I mentioned in another video, money is a tool and not the head, but a means to the end. Make money work for you Make money your prisoner. Yes, make money your tool. Money is plentiful for those who understand the simple principle or the civil law which governs its acquisition. And laws that govern it today will be the same laws which will control it millions of years to come, despite new technologies. We need to learn the law that govern the building of wealth and observe them. These principles are constant no matter where you are from, religion or culture. They cut across. To earn wealth is but a slight burden upon the thoughtful man. Bearing that burden consistently from year to year accomplishes the final purpose. That's a quote from The Richest Man in Babylon by George Clason. Let's first understand tax avoidance and tax evasion. Because knowing the difference between tax avoidance and tax evasion is important since it enlightens us on whether we are on the right or the wrong side of the law. Tax evasion is illegal and occurs when a person or when an entity eligible for paying tax intentionally avoids paying taxes owed. This, I tell you, may attract fine or imprisonment. Please don't try it. Avoid it. Our lesson today covers tax avoidance. And tax avoidance is the use of different methods and strategies to lower the amount of tax owed. This method is legal and therefore can be used by anyone or organization to reduce the tax payable. The lawyers say ignorance is no defense. I tell you it's true, since if one isn't aware of such loopholes, then you end up paying more taxes to the government. Different strategies will work differently for various individuals depending on their circumstances. Therefore, your personal circumstance may require a different approach. In our lesson today, there are 6 ways to avoid tax or tax avoidance. I told you tax avoidance is legal. The first way to avoid tax is pension with a registered retirement benefit scheme or retirement accounts. It's part of retirement planning strategies. I advise you to join a registered scheme because contribution to schemes are tax-free to the tune of 20,000 per month. That applies in Kenya. In different countries it may be different, but the rule is the same. Retirement benefit schemes allows members to make regular contribution during their working life. And once a member retires, this contribution plus accrued returns are utilized to provide retirement income to the member. These schemes can be broadly categorized to namely pension funds and provident fund. It is therefore important to note that saving through retirement schemes has significant benefits not only on retirement but during your working life, as you benefit from tax exemptions. Employees' contribution, regardless of the type of fund, are tax deductible up to the maximum of 20,000 per month, or that % of one's gross salary, whichever is lower. Furthermore, investments return from investment of these funds are tax exempt. Also, in case of lump sum payment received from registered retirement benefit scheme, the first 600,000 is not subject to tax. Lastly, pension payment after attaining age of 65 are also not subject to tax. Employers, on the other hand, receive tax allowance on contribution by deducting it as an expense in the determination of taxable income not exceeding 15% of each employee's salary. Some employers do match employees' contribution. If your employer doesn't offer this kind of facility, I advise you can easily initiate the process with a registered pension fund firm at an individual level. If your employers offer these facilities, make sure you take advantage of the same. Let's do an example and get to understand more about the implication of our lesson today. Assume this example applies at Kenyan context, but it can be replicated into other countries. Assume your monthly salary is 70,000. Then your annual salary is 70,000 times 12, the 12 months, making it 840,000. If an employee decides to do pension contribution, the maximum of 20,000 per month, 20,000 times 12 will get an annual contribution of 240,000. So the total taxable annual income is 840 less 240, making it 600. Let's observe real life practical situation for two employees, one taking the advantage of the tax loophole and the other not taking the advantage of the tax loophole. The one taking the advantage, we'll call that employee A, and the one not taking the advantage, we call him employee B. Our assumption is employee A makes a monthly contribution to pension of 20,000, and employee B makes nil contribution, but the monthly income is same 70,000. You realize for tax or PSU1 for employee A is 7,383.35, whereas the PSU1 or tax for employee B is 13,325 as per that diagram. Why? Because employee A is enjoying benefits for the pension contribution. So the total, down there you have the payee information. The gross pay for employee A is 70,000. Allowable deductions for employee A is 20,000. Taxable pay is 50,000. For employee B, gross pay the same 70,000. Allowable deduction 20,000. And taxable pay 69,800. You realize employee B is being taxed on 69,800, whereas employee A is being taxed on 50,000. And when we come down there and do annual tax analysis, for employee A, you realize his PSU1 or the government tax is 73.35 times 12, making total taxes to 88,600.2, whereas employee B 13,323.35 times 12, making a total of 159,880.2. From the above the diagram, you notice that there is a huge difference between the two employees in terms of tax paid to the government. Employee B ends up paying 71,280 more annually compared to employee who takes advantage of tax avoidance loophole. Since the amount is invested by the pension management firm, The amount attracts interest for the employee. And let's see the computation. If we assume employee A was consistent for 10 years with a return at 25% compounded annually, then we will be having an amount of 700. If we assume that employee A was consistent for 10 years with a return of 25% compounded annually, then he will be having an amount of 727,938.66 earned from government tax saving through tax avoidance. Note, all this amount of 727,938.66 is the tax portion or the tax element which should have gone to the government plus the interest thereof. But now it's money at the disposal of employee A, and that's financial intelligence. The second point is you can register your business. Starting a business and registering it with the relevant authorities. A business allows one to deduct expenses before tax. Rent, if operating from home, your business can rent your home for you and help you to pay rent. You can use a portion of your rent, house rent, and apportion it to your business. If you work from home and your home office is your house, you are allowed therefore to deduct expenses relating to business in your house office like rent, electricity, water, security, and other expenses contributing to you being able to run that business. Asset depreciation. Depreciation is treated as part of an expense. Asset for cars, machine, computer, or furniture. That's the advantage of having a registered business or registering your side hustle. The third is house ownership saving plans. This is a plan where the government has an agenda to enable you own your own home. With such a plan, you dedicate a portion of your income monthly and contribution up to 4,000 per month or 48,000 per year, which are not taxed. In addition, interest earned from the deposit you make of up to 3 million are tax exempted. The other one is take an insurance cover. Life insurance is a way to help protect loved ones financially in event of your death. A group life insurance and other insurance covers like education policy with a maturity date of more than 10 years qualify for insurance relief. The premium paid will qualify for relief, allowed to a maximum of 5,000 per month or 6,000 per year. The payout on maturity of the insurance are also not subjected to capital gain tax. These insurance policy plans reduce the amount of tax you are to pay. The other one is take a mortgage instead of a loan. A mortgage is an agreement with a financial institution that allows you to borrow money to purchase property. With this, you can get mortgage relief, where the law allows you to claim a tax relief of up to 25,000 per month or 300,000 per year. If you plan to buy property, it's important to take a mortgage rather than an ordinary loan, because an ordinary loan has no tax relief. The other one is persons with disability, or we call it disability relief. Persons with disability are assessed by the government medical institution, and upon assessment report, the National Council of Persons with Disabilities registers the person. If you are a person with disability, by virtue of this registration, you can apply for an exemption certificate at the Kenya Revenue Authority, that's KRA. Persons with the disabilities are exempted from tax on their taxable income up to 150,000 per month, or 1.8 million annually. Therefore, if you are in business or employment and do not have exemption certificate, you are losing out on huge savings. As mentioned at the beginning of this program, our desire is to empower you with financial knowledge, financial education, financial intelligence, so that you may be financially empowered. That's our desire, and that's the dream of this program. And today we have learned 6 principles of tax avoidance. Kindly use the principle that suits you well. And if you are in employment, formal employment, take advantage of pension schemes. You gain in savings, you gain in investments. And if you have loved and you have enjoyed watching and learning this information, kindly subscribe if you are new in this channel. Like and share. Thank you.